Good day, my name is Dean Crocker. I'm a research analyst with the PSG Wealth team, and today I'll be taking you through our latest EIA report completed on AECI. So on the 26th of April 2021, AECI released its full year 20 results. I'm just going to run through a quick executive summary. The results were largely impacted by a significant number of once-off costs, particularly relating to obviously the COVID-19 associated losses, as well as a sizable goodwill impairment to their Much Asphalt business. And then there were some restructuring costs incurred in the chemicals division, which should not be seen in periods going forward, but should definitely benefit future results in terms of operational efficiencies. The group reported stronger free cash flows, and this resulted in lower gearing ratios. And pleasingly, across divisions, there was an improvement in the revenue diversification, as well as intersegmental revenue diversification. So what I mean by that is in terms of the mining segment, they're nicely diversified across different commodities, which almost adds greater diversification across the group. In terms of recommendation, it remains an overweight. This is really underpinned by the low double-digit ROEs, roughly trading between 12 to 15%. The sound free cash flow has really been a highly cash generative business, and this has allowed them to reduce their debt size significantly. It's down to roughly about 2 billion from about 4 billion, so it's reduced in half. A nice discount to both its 5-year average and its peers, as well as in terms of our DCF calculation, that was a trading at a discount to its INAV. This is also benefiting and underpinned by a forward-looking decent dividend yield of roughly about 6.2%. So just in terms of the event, so on the 26th of April, they released the full year 20 results. The group was impacted by COVID-19 lockdown associated losses, and I think this is much of a case across pretty much all industries that operate within South Africa. Within the mining industry, obviously people weren't able to mine, so they weren't using as much explosives and chemicals and etc. that AECI offers. The Much Asphalt business, which resulted in that large impairment, once-off goodwill impairment, was impacted by a lack of transparency in terms of future government road spend. So really on the infrastructure side of the business. And based on that, they had to write off their impairment. Now, that might be a once-off impairment right now and will impact the results. And we'll talk to headline earnings and the actual underlying performance of the business. But it does allow the balance sheet to improve going forward. You will see improvement in terms of ratios as you've written off quite a large sum of the intangible assets. The operating profit, including that goodwill impairment, that declined by 55%, and then headline earnings, which excludes that impact, was only down 24%. They did, however, despite all of the turmoil, declare a nice sizable dividend of 470 cents, which did help them achieve quite a nice dividend yield, still rough around that 6%. So as I mentioned, the cash flow from operations is 68% higher at 3.1 billion. Net debt halved from 4 billion to 2 billion. And the net debt to EBITDA ratio is below 1. So effectively, right now, the group does generate significant cash flow above what their net debt is, which puts them in a nice position going forward. So in terms of the impact on date of release, the share price increased slightly relative to the JSE cap, so it was slightly higher. Since the beginning of the year, they have underperformed the benchmark, however, by 8.4%, with a year-to-date return of 5.7%. And since our last recommendation, which was in January 2020, the share price has declined by 31%. In terms of the valuation on a historical EV/EBITDA basis, the group is trading at a 19% discount to its 5-year average and a 30% discount to its FactSet peers. In terms of the DCF valuation, which you can see in the table on the right, we have highlighted a valuation of roughly about 115 Rand. And this is based on the assumptions just highlighted below there. One of the concerns that we have is that the return on invested capital is, however, below the weighted average cost of capital, which is something you should never and want to see. However, we do have an exit multiple of 6 times, which underpins the DCF valuation. So based on all these factors, it does seem like the group offers value across multiple sectors and vectors. We do feel then, based on that there is value and some upside from the current share price. Just in terms of the assessment, AECI operates in a niche market. There's not too many listed peers that compete with them in terms of their their mining segment, particularly in the explosives. They then have the benefit of the diversification into agri-health, which is something we're quite bullish on. It's still small in terms of their business, but in light of food scarcity across the world, improving yield production on crops really is at the forefront of a lot of business minds, and they are in a niche position to take advantage of that. And that business has seen quite a bit of growth, and we have highlighted in the EIA. In terms of the chemicals business, that's undertaken a big restructuring in terms of their costs, and we really do expect significant synergies to flow from that. Then just in terms of the water division, that's also a nice business. So they have quite a nice diversification across sectors. The water business, I think it still lacks a bit of scale, but it's something that they can gain. There are quite a few potential government contracts, and by the state of our rivers and our water affairs across the country, there is definitely much needed expenditure by government in that sector. So one thing that we have seen is the group obviously has managed to expand their geographic reach as well. They are operating largely outside of South Africa. They do still have a big footprint in South Africa, but given that they have offshore or cross-border operations, does offer a rand hedge. They have remained highly cash generative even in these very difficult times, which has allowed them to improve their balance sheet significantly, and it really lays a nice foundation going forward from which to grow. The future earnings we do expect to be supported, as I mentioned, from the balance sheet and then the cost alignment initiatives, particularly in the chemicals business. They are, however, exposed to exogenous factors and commodity cycles, largely not so much the commodity price, however, could be seen as indirectly, but more commodity volumes. The greater production allows for greater use of their products. And we could almost assume that a higher price should imply that mines would be more active in the market. We could also assume that more mines might open based on the higher prices, but the volumes really drive their business. One thing that is concerning, and I just noticed the caution there, is in terms of the group, there was a proposal by the REMCO just to allocate a portion of the COVID losses back into earnings to determine the remuneration incentive for the executives. We're obviously not going to comment too much on it. I don't think it's something that was too pleasingly accepted by the market, and it was actually rejected by shareholders. It just highlights some of the ESG risks associated with the companies. It must be noted that this is quite a seasoned management team, and they've been in the business for quite a period of time. But it is obviously a concern to us when management start to try and benefit themselves to a large extent in these actions. However, based on everything and despite that, the business is still sound. It's in a niche market. It has significant headroom to grow in other sectors. I do feel that the mining business is probably just going to underpin the results, and if it continues to grow by single-digit growth, that would be great, allowing the other segments to kind of catch up to it, diversifying its earnings base. It is trading at levels below what it has seen in the past, particularly on a forward-looking basis, and it is underpinned by a nice dividend yield with strong cash flows. And on the back of all of that, it leads us to a recommendation of an overweight position. So if you'd like to place an order, you're welcome to speak to either the trading desk or your financial advisor. And then just please take note of the disclaimer and have a great day further.